Happy Monday out there, folks. This is Darius Dale here to present our macro minute for Monday, July 25th, 2022. Welcome back to everyone. For myself, asset markets here. Stocks mix this morning of commodities up, crypto down, dollar down, global bond yields up. Shifting to our market moving headlines, expect policymakers to over tighten. So Janet Yellen told NBC she doesn't see any sign of broad recession, which in our opinion, we're interpreting to mean that the Federal Reserve and the Treasury, which have been working in unison to drain liquidity from financial markets, will continue along that path in terms of what the Fed is doing with its balance sheet, the reverse repo facility, and ultimately what the Treasury is doing in conjunction with that with respect to the T-bill shortage, the carefully engineered T-bill shortage, which itself is a function of the bloated Treasury general account balance. So it's our expectation that the net liquidity function in the economy, and more importantly for our asset markets, is likely to remain negatively sloped well into Q4 of this year, unless we see a sooner Fed pivot, which would be very incongruent with our analysis of inflation dynamics, both reported and expectations. Consensus is right here. So the Bloomberg's MLive Pulse survey, they have their own survey that they conduct for terminal subscribers, and they said a recession will be the price of taming inflation. Over 60% of respondents said there's a low or zero probability that the Fed can rein in price pressures without triggering a contraction. That 60 needs to go to 100%. We've done a tremendous amount of work on this in terms of the impact of recessions upon things like employment, GDP, financial markets, corporate profits, et cetera. That's all featured in our July 22 macro scouting report. And one of the key takeaways there is that Fed is not going to achieve its expectations for core PCE next year without a recession. It's very clear based on the historical sort of relationship between the drawdowns we historically seen in headline CPI, core PCE, et cetera, that the Fed effectively needs a recession in order to get core PCE down to where it needs to go. So that's our view here. That's been one of our views, and one of the views that continue to give us confidence that we are operating in a different Fed reaction function regime than the prior growth-oriented, financial stability-oriented Fed reaction function regime. And I think understanding that we are in a different regime will be very critical to your performance throughout the second half of this year, not necessarily your performance July to date. We're obviously experiencing a decent amount of FOMO. And then lastly, the global liquidity cycle downturn remains ongoing. So the ECB may not be done with its large rate increases either. Its surprise 50 basis point move last week was not just front loading, and the expected hike in September needs to be, quote unquote, quite significant. Per Martin Kazaks, who's on the ECB Governing Council, he's the president of the Latvia Central Bank. We had Robert Holtzman of Austria told policymakers may need to accept the fact that a moderate recession is necessary to stabilize prices. So we continue to see policymakers, both domestically and globally, a little bit more hawkish than investor consensus is morphed to in recent days and weeks, largely driven by the decline in food and energy prices. We don't think that is the only factor driving inflation higher as we continue to see core inflation pressures build, particularly here in the U.S. economy. We got a heavy week of macro and micro catalysts. You got Alphabet, Apple, Amazon, Microsoft, and Meta all reporting earnings this week. All eyes are on the forward-looking guidance. Obviously, Q2 earnings were likely to be generally well received, but the forward-looking guidance we will see is really what investors should be focusing on. EU energy ministers meeting on Tuesday. We'll start to see if there's any credible contingency plans with respect to the EU's ability to sort of, I guess, defend itself against a potential weaponization of crude and gas flows from Russia later this year. Then we also have obviously all eyes on the FOMC meeting this Wednesday. No summer of economic projections. So really the press conference from Chairman Powell is really what the markets are going to be focused on primarily. Then you get Q2 GDP on Thursday. It's expected to be slightly positive, could come in slightly negative. That will put the U.S. economy in a technical recession if it does come in slightly negative. But again, there's a big difference between a technical recession and a hashtag actual recession, which is another thing we unpacked very deeply in our July 22 macro scouting report. So go check that out if you haven't seen it yet. And then lastly, Eurozone July CPI, we'll get that Friday alongside the June PCE data, both income, spending, but also core PCEs, the Fed's preferred inflation metric. We'll get that on Friday as well. And then the July final readings for the University of Michigan Consumer Sentiment Survey. Big movers this morning. You have the 30-year nominal treasury. It's up 10 basis points to 3.07%. down 25 basis points month over month. 2-year nominal treasury yield up 5 basis points to 3.02%, down 10 basis points month over month. I thought it was pretty interesting. You're now starting to see a little bit more pin action on the long end of the curve relative to the shorter end of the curve. So that's very clearly telling you that some contingent of the market is really starting to morph into the belief that the Fed is going to be A-OK with allowing inflation to settle in at a much higher level than we've seen in recent years. And that's why you're probably seeing a little bit less of a response in the short end of the curve relative to the longer end of the curve. We think that is the wrong view. We would be taking the other side of that view, with respect to the next 3 to 6 months. And then lastly, Bitcoin down 4% to up 3% month over month, down 68% from its 1110 high last year, November 10th. And then Ethereum down 6% this morning to up 25% month over month. It's also down 68% from its November 10th high. We did a great job of getting a lot of investors who were paying attention at the time out of crypto in early December of last year. That's quite frankly a hell of a call for someone who's not really glued to that asset class. But again, I don't think you need to be glued to the asset class. I think you need to be glued to the growth cycle, the liquidity cycle, the inflation cycle, the profit cycle. All those things will tell you where crypto is going, just like they tell you where stocks are going, where bonds are going, where credit's going, where FX is going, et cetera, et cetera. Taking it to the charts here, before we get into our volatility adjusted momentum signals and probable ranges, just wanted to remind investors like the percentage change math starts to get very nonlinear and very adverse if you are, you subject yourself to FOMO that ultimately turns out to be a bad investment decision. And so one thing on the left chart here, and I'll let everyone download the deck and kind of look at themselves, but what we're showing here on the x-axis is the max drawdown from whatever high we're studying from, and the percentage change you need in the blue bar to recover those prior highs. So for example, if you're down 50% from the high, you need to go up by 100% from that local low or from that low to get back to break even. If you're down by 70%, which is where Bitcoin and Ethereum are, effectively this morning down 68% apiece from their November 10th highs, you need to go up by 233% to get to break even. So, I mean, a lot of investors bought those highs, and a lot of investors have been buying, local highs all the way down, which is another thing we want to call out, which is the sort of local drawdown math. So it's not just the max drawdown, because not everyone has bought the highs, not everyone's cost basis at the highs, but there's a lot of cost bases somewhere between the highs and now most recent price, certainly from the dollar cost averaging community. And the one thing we wanted to call out is just a sort of percentage change drawdown to the next 1,000 basis point max drawdown marker. And so that's a mouthful. Let me just explain what the table means. It just shows the blue bar should show the local drawdown you're going to experience just going from down 0 to down 10% or down 20 to down 10 to 20% and so on and so forth in terms of max drawdown level. And so right now, Bitcoin and Ethereum are somewhere around down, let's call it 70%. And so to get to down 80% from here, it's not just going down another quote unquote 10%. To get to down 80 from the all-time highs, it would be down 33% from the local low. Let me slow down and say that again. To get the down 80 from down 70% is not a 10% drawdown. It's a 33% drawdown to get to down 80. And so as we've seen in these crypto bear markets, these crypto winners in years past, you've seen Bitcoin decline 80, 85, 90%. And so if you're talking about going from down 80 to down 90, it's not another 1,000 basis points. It's down 50% from that local low. And so this is the kind of percentage change math that gets increasingly negatively convex with respect to the kind of damage you're doing to your portfolio if you buy the dip too early. And more importantly, the increasingly positive convexity you typically see if you're sort of if you're just riding it all the way down, the positive convexity you need to see to get back to break even. Getting into our volatility adjusted momentum signals and probable ranges. US dollar index, that's bullish VAMs, finally oversold here. Once we start to get the bounce, you're probably going to see a lot of red on your screens from a risk asset perspective. So I would be just expecting that heading into the FOMC. The dovish left tail outcomes is probably priced in with the dollar being at the lower boundary of its probable range. So be aware of that. Gold bearish VAMs here. You got about 1% of upside versus about 4% of downside. 10-year nominal treasury yield, that is bullish VAMs. That is oversold here. High yield credit spreads, bullish VAMs. That is also oversold. S&P 500, that is neutral VAMs here. You got about 1% of upside, 6% of downside. VIX broke the bearish VAMs last week, but right in the middle of its probable range. We don't expect that bearish VAM signal to hold, just in so much that the earlier ones we've seen earlier this year have not held as well. NASDAQ 100, that is neutral VAMs. You got about, 2% of upside versus 8% of downside. Russell 2000, that is neutral VAMs. You got about 2% of upside, 8% of downside as well. Bitcoin bearish VAMs, that is overbought. Ethereum bearish VAMs, that is also overbought as well. Shanghai Composite neutral VAMs, that's got about 1% of downside, 4% of upside. WTI crude oil neutral VAMs, you got about 8% of downside versus 15% of upside as well. And then ag bearish VAMs still in the middle of its probable range. Industrial metals bearish VAMs almost overbought, 1% of upside, 9% of downside. So with that, Darius Dale presenting our macro minute for Monday, July 25th, 2022. Best of luck out there this week. Cheers.